capital market. But I'll leave you with some time, few seconds, to ask me any question. All of us know that if you lend or borrow for 1 year or more, it constitutes the capital market. All the financial products, institutions which operate in loans or shares for 1 year or more, they fall under the umbrella of capital market. And there are so many instruments of it. We'll discuss all that. Government bonds are there, corporate bonds are there, NBFCs are there, mutual funds, hedge funds, investment banks, venture capital, angel funds, hundi, these are the products of the capital market. You want to take one quick look at the graphic, the financial products, the instruments of capital market. You can. Oh, you are searching in front of us. Why didn't you do this earlier? In front of them, if you are searching,
it was not.
Some right to privacy. No. I think you were celebrating Dashara too hard. Took it too seriously. Capital market. So rest of the homework you do there. This is the introduction, long term and all that, primary, secondary, participants. Take a look. Primary market is, you are a company, you have issued shares or bonds or debentures or mutual funds. When we all buy from you, it is a primary market. Okay, there is a company, TCS, you bought a share of TCS. Directly from TCS, primary market. You sold it on the Bombay or National Stock Exchange, secondary market. Secondary market is when it is bought and sold in the stock market. Primary market is when it is bought and sold directly from the issuer, that is primary. I have a share of TCS, you want one, okay, we'll transact on the stock market, BSC, NSE, we'll come to that. Short selling is very important, because it has all this, I have to tell you. If not now, after 1 hour I have to tell you, why not now? See, regarding Adani Enterprises, why only enterprises? All Adani companies, all. They were in news last February while the budget was being presented. Hindenburg was short selling Adani. Budget was terrific. Adani was horrific. Even while the budget was good, Adani was collapsing like a stone or a knife. It was crashing like a knife. Nobody was touching it. A falling knife. Why? Simple. I should be talking about it after 1 hour, but I hope you don't mind. You know, so there is a company. How does the company's share get its value? So how do you know the company is worth 100, not 90, not 110, not 50, not 200? Why 100? So, okay, Adani ports, they have ports. Actually, one Mediterranean port of Israel called Haifa, Adani bought it up from Israel, Haifa. I'll write here.
Yes.
Okay. This can come in the preliminary. Haifa port, Mediterranean port, Israel, Adani bought it. So Adani ports, how much is what are the assets they have? Some ports they have, some ships they may be have. Assets, liabilities, the future of the business, the management, Adani and all that. So put all that together, compare it with the other companies running ports. So what is the value? Others are quoting at 100, their fundamentals are X. Your fundamentals are X plus. Let's say is Adani X plus. So if they are quoting at 100, the entire worth of the company, I told you the factors. You may be 110 and you are highly professional. 115. 120. But if you are valued at 200, you know, some people are dumb, sometime. All people are dumb, sometime. All people are not dumb all the time. So guys are watching you. Hindenburg thought they had a selfish interest, please. On day 1, we discussed, we are all driven by selfish interests. But within that, my selfish interest is, if I can catch a company which is overvalued, sell the share at 200, cash it at 120, did I not make profit of 80? That's my self-interest. Your self-interest is to ensure that your stock price doesn't fall, keeps growing. That's your self-interest. Let's see where we go. So your selfish, my selfish interest can clash, and in the process, public is the beneficiary. I'm also beneficiary, because I've caught you overvalued. So Hindenburg guys, America, their job is this. Look around to see whose companies' shares are overvalued, sell them. How do you sell? I don't have the shares. Hindenburg doesn't have the shares. I'm Hindenburg. You guys are the shareholders, foreign institutional investors, and you've got lakhs and lakhs of shares of Adani companies. So I tell you, brother, please lend me. I want 1 million, 10 million, 5 lakh, whatever. I want to borrow from you 5 lakh shares of Adani Enterprises. Borrow. And I'll give you interest. Whatever the interest going around in the market, I'll give you. So I borrow shares of Adani companies, borrow from the guys who have it. They have the shares. They are not selling. They are not selling. I want to sell. I'll return the shares to you. And for the time I keep your shares, I'll pay you interest. 100 rupees worth of shares, I'll pay you whatever. So you're also making money. I'm sure I'll make much, much more because I'm short selling. You don't have the guts. You don't know the value of Adani. I know he's overvalued. Give me the shares. I'll pay you interest for that. Those shares I will sell. Sell at what price? I feel the price of Adani is too highly overvalued. 200 rupees a share. I don't think it's worth that much. Lots and lots of imaginary, speculative factors are brought into the valuation. We can look through it. Its value is about quarter of that. 1/4 of that. That's my view. Hindenburg. So they borrowed the shares and sold them. They didn't have the shares. They borrowed the shares, sold them, pummeled them, hammered them down from 200 rupees to God knows 50 rupees, and then started buying at 50. So what did I take from you? Shares. I bought at 50, sold at 200, 150 rupees profit I made. So I bought at 50, take your shares back. Interest? Take your interest. I made 150 rupees on a base of 200. You also made money. You are a conservative person. You are a, you don't want to take risk. Whereas my job is taking risk. I'm Hindenburg. So that's called short selling. Selling shares without owning them. You do it by borrowing them. And for the borrowed shares, you pay interest. You sell at X price, hoping to buy at X minus, hoping to. Adani was so badly overvalued. Even with the finest of company, he could not protect his share price. Oh, LIC is with him, SBI is with him. Who is not with him? Even then his share price got, lost its value 75%. Blood on the road. The guys who held Adani, small people also held. They were crying. Big people also held. So this is a classical operation of short selling. I hope you understood.
Yes.
Yeah. Why did I talk about it out of turn? Because it's here. Instruments I'll come to. Regulations, SEBI I'll come to. Liquidity, whatever that is I'll come to. So this is the first look about, I think there is one more also. These are not instruments. This gives you a look at the list of instruments. Stocks will come to. Bonds will come to. Mutual funds, angel funds, venture capital. Yeah, and one more. Oh, this will come later. Okay, now let me start lecturing, discussing. So, money market we covered. We are into capital market. That is 1 year and more. And about the capital market, one instrument we are all very familiar, that is government bonds. Government securities. Securities are what? They are secured against the assets. General meaning. Some may not be, but that is how the name came. Here is my asset of 100. I'm issuing a bond to you for 50. In case anything goes wrong, I'll sell this and pay you 50. That is what you call secured, collateralized, secured. Call money, if you recall, unsecured. I'm not keeping any security. I'll write a promissory note, you can drag me to the court. That's another story. And my reputation is such that I will pay you. I have a reputation. But I have no collateral to keep to borrow in the call market. But government securities are secured against the consolidated fund and all. So, government, RBI, told RBI, issue the government bonds 1 year. Remember the day before we learned 1 year to 40 years, and next week the 50-year thing is coming. So you're going to write 1 year to 50 year, tenure, whatever, maturity, bonds, RBI will issue and transact, sell by on behalf of Government of India or the state government. State government is state development loans. Central government, there is no such name. 1 year and above. That is the government securities. Corporates also have their bonds. Corporates have their bonds. Just like the government, RBI doesn't come into picture. You are a company, there's a company here. Float the bond. What is a bond? Bond is a debt instrument, number one, floated by a company, number two. It carries a fixed or floating interest, number three, which is paid periodically, number four, and it is secured against the assets of the company issuing the bond, number five. That's it. That is the bond. But in that, there is something else. So government securities are bonds. Bond is one. In general, in this classification, bill is for up to 364 days and bond is 365 and beyond. 365 days and beyond. So corporates also can do the same. Bond. There is something called debenture. But before you understand the debenture, you need to be taught a few other things so that you are acquainted with the market. Understanding becomes relatively simple. So then there is mutual funds. He is running a mutual fund. Whoever he is, Tata. You know what he tells us? He tells us, see, I'm going to build a fund, mutual fund, give me money. I will invest in, stocks, bonds, whatever, government bonds, all that. And, the risk is not mine at all, risk is yours. Give me the money, I have done this before, I know how to do it, but market is market, risk is there. But I'll try to see that you make money. So he will invest. And then he'll charge you a bit of money for investing. And if your 100 becomes 105, he'll maybe take a buck and give you 4. If your 100 becomes 95, he'll still take a buck and give you 94. So his money is constant. Your money can vary depending upon the returns, up or down. That's in nobody's hands. After all, people thought Adani stocks were super gold. Nothing above Adani. But then what happened? It's a highly technical exercise. We have no idea what's going on. So mutual fund people, they say we have an idea. That's a mutual fund. Regulated by SEBI. But there is another fund called hedge fund, mutual fund. See, I told you there is this guy A. So A is Tata's. We are, setting up a mutual fund, open to everyone. We are advertising in the newspaper. We collect 100 rupees. We close the counter at 100. We don't want to collect more. And this is how we are investing. We have invested in Reliance, TCS, Coal India. And this is our website. This mutual fund is called XYZ. This is how we have invested. Net asset value, that is, we have invested in Infosys, share price went down because the Prime Minister's wife has a problem. And we have invested in TCS, share price is going up, whatever. We have invested in, so some prices went up, some went down. What is the net asset value? We invested 100. For about 40, the price went down. For 10, it's flat. 50 shot up by 20%. So net asset value, your 100 became 110. Net losses, gains, netted out. What is the, effect? 10% it went up. I'm going to declare it on the website. It's there on the website. That is a mutual fund. Hedge fund is, again, that's also private, this is also private. There is this guy, company, whoever, individual. He says, among his friends, among the knowns, he says, give me money, I'll invest. And that mutual fund, as I told you on the website, details of every paisa, every investment is presented. Whereas this guy says, I'm going to raise money from the people, close the circle, I'm going to invest. I won't disclose who gave me the money so much, I'll disclose, okay, a little bit. I'm not regulated by SEBI, etc. Regulated but not so transparent. Disclosure is very low. So, the regulatory framework for mutual fund is X. Hedge fund, which is a mutual fund with less of transparency. I don't have a website. I'm not accountable. Small coterie, I have collected money. So hedge fund accountability, disclosure is less, accountability is less. That is a hedge fund. The other one is a mutual fund. Then there is another. Exchange traded fund. Exchange. It's a mutual fund. It's a mutual fund. There's no difference. He is there, collects money from all of us, invests in stocks, it is listed on the exchange, and it is traded. So how is it different from a mutual fund? There is no difference at all. There is no difference at all. But then it covers more than stocks and bonds. Let me explain. See, there is a gold company. Their job is to buy, give loan on gold, all that. They have gold, they're sitting on gold. So what they do is, generally what happens is, modern people, modern, current generation, what happens is, they want to invest in gold for security, capital, returns, liquidity. Gold has two types of value. One is what I described just now, another is ornamental. I think the ornamental value could be vanishing. I don't know what's going on. I think gold is basically investment. So, why should I buy gold physically? This guy, I just now described him, the gold company, He says, you want to buy gold? Why? I want to earn, so I'll do something. I've got the gold. You, on the basis of the 100 rupee worth of gold, I will issue ETF receipts. Give me $1. I'll give you $1 receipt, 1 rupee receipt. It's worth 1 rupee worth of gold. How much is it? X amount of gold is worth 1 rupee. Today, take this receipt, you gave me 1 rupee, which is worth 1 gram of gold. You give me 1 rupee, 1 rupee, 1 rupee. 100 I have collected. Underlying is the 100 of gold. List it on the stock exchange. And as the value of gold changes, the value of the receipt changes. This receipt is in a dematerial form, dematerialized. That's a bank account, demat account you have. Keep it there. No risk at all. Nobody will steal your gold. It is liquid. The day you want to sell, you sell on the stock market, it's trading. Whatever gold does, it does. The advantage is, it's simple, number one. The country doesn't have to import gold. You see, we are spending billions of dollars worth of money to import gold, and gold is, what is gold? Gold is basically, if you buy gold as an ornament for ornamental value, no. Instead, if you buy a share of Reliance, he will take your 1 rupee and invest it, generate employment and generate exports and earn foreign currency and so on and so forth. But if you buy gold to make for some jewelry, then basically it is idle between the two. You want liquidity? Paper is also liquid. You can sell it anytime. You can collateralize that and borrow money. So this is an exchange traded fund. On the basis of the gold or on the basis of stocks, whatever, take money and list it on the exchange. I really don't know how ETF is different from mutual fund. There is no difference. But then you have to call it ETF because the financial products which the money is invested in are a little unconventional. It goes back to Lehman Brothers and all that. So whatever, so ETF is a mutual fund, full stop. And that's also understood as a capital market instrument. So now you know bond, mutual fund, hedge fund, exchange traded fund, etc. Government security also you know. Now you need to know, debenture. All these words you grew up hearing and you wanted to understand. Debenture. Okay. This is the company. They are attracting, they want you to put money as a deposit and they'll give you 8% per annum. Good company, great company. Maybe Reliance, maybe TCS, whatever. So put your 100 there. After a year, go back home with 108. Or if they say, okay, I'll pay you 2 rupees after 3 months, 2 rupees after another 3 months, whatever the deal, the contract, the terms. That's a plain deposit. It's a deposit. It's not a bond. Bond does the same thing. Take this bond, give me 100, come back after a year, take your 108. Bond does the same thing. But if you dig in technically, there must be some differences. Bond is collateralized. Is the deposit collateralized? Maybe it is, maybe it is not. So deposit is simple. Take this 100, give me interest, etc. Bond is simple. Buy the paper, the security, give the money, and after a year, return the paper, take the money back with interest. Now, this is a plain deposit. But then the company will make it attractive. You see, the company can survive only as long as those who have faith in the company, have good returns on their investments. So the company tells you, see, give me a deposit, bond, it's a debenture, bond, take this paper. Generally, this is the bond, this is the debenture. Generally, this is secured. This is unsecured. I'll sell you the paper, you buy it for 100 and 8% is the interest after 1 year. 108 I'll give you. That's a debenture. And in case I go bankrupt in the meanwhile, you also gone. Whereas bond, I'll sell my assets and pay you because it is secured against my assets. Debenture is generally unsecured. Generally, please, there are all sorts of combinations in financial products. So I'm not saying this is universally all time correct. No. This is general. Unsecured, number one, otherwise operates like a bond. Generally, a debenture can be fully convertible, partly convertible, non-convertible. So, okay, take this paper, 8% is the interest, give me the 100, after a year, you take 108 from me. Nothing else, nothing more to the story, that's a debenture. To make it more attractive, see, my share price is 100. I will give you, how much is the money you are buying the debenture? 100? 50% of it, 50 rupees, partly 50, 40, 60, partly, I will convert part of your debenture investment into shares. Generally, obviously, it has to be concessional rate. Everyone buys my share at 100 in the market for a while, that's a stable price. I will convert part of the money that you have invested in my debenture into shares. Oh, you're not only getting 8%, on top of that, you are also getting my shares at a concessional price. You are doubly thrilled. So that's a bit of a thrill I'm adding so that you are happy. I want to thrill you even more. See, this 100 you have given me, 8 is what you are getting, that's a debenture part. You want to take the 100 back with interest? Fine. If you don't want to, the entire 100 I'll convert it into shares at a value which is less than the market value. Then you are super thrilled. Here is the debenture, fully convertible into shares after 1 year. If you don't want, you'll get 8%. If you want it, you'll get the conversion after 1 year. So for this 1 year, you'll get the price off. You'll get the returns as interest, and after 1 year, the whole thing goes into a share mode. So yeah, that is debenture. As I told you, the idea is to ensure that the investors are happy, happier, even more happy. That is the logic. Why is everyone worshipping that person, Mukesh Ambani? Why? Because people built all sorts of assets by buying the shares of Reliance. Stable, prosperous company, diversified, and it will always get you decent returns. So how to His mission is to ensure that investors are taken care of under all. He is living in a mansion. Nobody bothers. They like the fact he is making money for himself and all his shareholders are, prosperous. So that is how, co-prosperity, shared prosperity. So which is what you call debenture, fully, partly, and non-convertible. That is debenture. Now, in recent years, new instruments have come. Okay. If you are into finance, you know your investment strategy, you will do it yourself. But, see, someone is a professor. He teaches history. His mind is fully occupied in history. He gets money. He doesn't know how to invest. He knows conservative instruments, government deposits and all that. So there is a guy who tells you, come, give me the money, share prices are going up and that money is going into the real estate. We have dealt with it. We have 15 years of experience. We know where the prices are going up and whatever, this is we are establishing a fund of 1,000 rupees, $1 receipts, buy. With this 1,000 that we collect, we will invest in real estate and the 1,000 becomes 1,100, 1,200. Again, like a mutual fund, we'll keep a little bit, we'll distribute and we are listing it on the stock market, stock exchange. You gave me 1 rupee, the 1 rupee became 1 rupee 10 paisa. You want to quit, you quit. Liquid number 1, returns number 2, tapping the real estate opportunities number 3. We are not running away anywhere number 4. That's because SEBI is our regulator, because we are a mutual fund. So that's another financial product available. Similarly, INVIT, Infrastructure Investment Trust. Tomorrow in the prelim a question comes, who regulates this? See if the word trust is there. Trust is, in this context, capital market context, trust is SEBI. If it is non-banking finance company, it is RBI. I'll come to NBFC little later. So, infrastructure. Power grid is there. National Highway Authority of India is there. Power grid has all the lines, transmission lines, the grid, distribution. They have built them up. Now they are looking for money because they want to build even more. So they say, these transmission lines, you manage, you give me 100 rupees upfront, you manage that. Every year it will get you 10 rupees, 15 rupees, 20 rupees, whatever. Prices are going to go up. This is the flow we are expecting. So if you give me 100, actually you'll be gaining by 20 rupees every year. Okay. Then this guy is there. He will collect money from people. See, I'm going to invest the money in infrastructure, a road, power line, port, airport, and anything else. Give me the money. I'll invest there. Stable income. I'll give you a dividend also because it's all profit. When is power going out of fashion? When is power going out of utility? So we all give him $1 each and buy the INVIT and he'll collect the money, he will invest in the infrastructure and he'll manage the infrastructure 30 years, 20 years, whatever, it's leased out to him. After that, it could be renewed. And so what's the win-win here? We are winning because for our 10 rupees, the returns are 10% or 11%. We are happy. Power Grid is happy because it has got the money to build a new transmission license, because the government says, we can't give you any money, you find out how you can raise money. This is one way, so you monetize your assets. Point number 2. Power Grid is fine. We are fine. Infrastructure is fine. So it's a win-win-win. That is how infrastructure investment trusts operate. It's a trust in this context. So SEBI regulates. SEBI regulates. And another channel for capital market is there. That is called, any graphic? In the meanwhile, not yet, but I'll shower you with graphics in course of time. Not yet. So another graphic is there, another, not graphic, topic, which is, which is angels. Angels. They call themselves angels. Everyone started calling them angels. That's how the name came. So who is an angel? See, some of you, I'm sure, have great ideas. Those people who came from farming communities, rural communities, you have super ideas how to bring the producers, the farmers together, how to inform them, how to, in marketing, cultivation, credit. You have a lovely idea, saleable idea, lucrative idea, big idea, and you got some friends. Work on it for a while. There'll be an angel. Angel is the guy who has money, his own money. His money means 2-3 guys have come together, or only one guy. He's got the money. That money, he sees terrific potential in you. He can go wrong. You're seeing it in the papers. You can go wrong. What an idea. He says, okay, you're going to do very well. Terrific idea. You're going to make money. So this is how I value. You guys are good. You can run a business. Idea is good. We'll fetch you money. And all things put together, I value your company at 100 rupees. I will give you 50 rupees, whatever. And then 50 rupees of your company is mine. Your company is worth how much? 100? I'll give you 50. So I'm the 50% shareholder. He gives you 10. You got only 40. I've got 50. He's got 10. So that's how the company ownership is shared. And I'll do everything that it takes for you to come up. So what do you call that guy? Angel. Why is he called angel? Generally they support internet companies, and internet is virtual. Angel is also virtual. So they got the name angel. So he is an angel investor. You know what this guy does? He collects money from a few angels. He keeps an angel fund. He does the same thing that the angel does. An angel invests his own money on his own. Angel fund is the guy who aggregates the monies of the angel investors and constitutes a fund from where he will support the startups. Startup means internet, web. There is no other startup. Because that is where you have multiplication. So that is an angel. Angel. And there is a venture capital also. Venture, after all the idea I told you, agriculture. Whether it is going to bomb or whether it is going to zoom, we have no idea. See what is happening to Indian startups. What all story has been played up. Now the bubble burst. guys are going home, you know. So it's nobody knows for final. Everyone is speculating. So terrific idea. It's a venture, adventure, risk and reward very high. Risk is high, reward is high. And this guy is there, public money, you know, public money. He collects money from public, maybe State Bank of India, maybe HDFC Bank, they have their venture capital fund. From that, they will loan shares, whatever, they will give financial, they will invest in a startup which is a venture. So venture capital is public money used to fund a startup for, you know, in the form of loan or equity. If I give you loan, you have to return at some interest. If I buy the shares, I will go up or down with you. A lot of people bought the shares of startups. You know, bluest of the blue. I don't know how they bought. When they bought, some people made money, but then some people lost. So, you know, it's a very difficult game getting the valuation and stuff. So, angel guy, his own money. Venture capital, public money. Both of them do identical things. Incubate, that is, see, I gave you the example. You know, you are going for civil services, you are reading agriculture, and your mind functions brilliantly. Suddenly you leave civil services and go for a startup. You and two other guys, startup. Work bloody hard, within 1 year your valuation is $50 million. This guy will, you know, invest in you. So, public money, private money, startup, internet related, there is a definition. And that is how the venture capital works. There is something more to the story, not entirely important for civil services examination. I can't rule out in the preliminary. Main far too remote. Preliminary is getting slightly advanced. You know, therefore, I will venture into this concept called private equity. Follow me. I will tell you like a small little story. Don't give it exam value. Comes in the exam, you know, that is the icing on the cake. The cake is understanding. So it's called PE. Private equity. You know, we are dealing with the financial world, which is about the most dynamic, explosive, etc. You know. So, there is a company, listed, unlisted, whatever, there is a company existing for some time. It's not a startup, and it wants to do even better. It wants expertise, managerial expertise. It is also looking for a bit of cash. So that company has been approached, or they approach. This is investment bank. I'll come to investment bank a little later. These guys are there, they have got cash. These guys are there, a pre-existing company, they want the expertise, they want the financial resources of the investment bank. So they tell the investment bank, come, here is a bunch of shares of our company, equity means shares. So you take these shares, take means buy decent amount of shares, not 1 or 2 or 1,000, 1 lakh, quite a few. Percentage 5, 10, take, buy at a decent price, come, be with us, manage the company, bring it up, Lock-in period is 1 year, 2 years, 3 years, whatever. After that, I'm sure we'll start doing much better. That's why you are coming to us. Let's manage the company. And then after 3-4 years, whatever the contract, you quit and go. That is what you call the private equity. Equity shares. Equity shares, what is private? That company which sold you shares has not sold you on the stock market, has not issued the shares in an IPO. Privately they gave you. Privately they gave you private placement, shares, equity, along with the contractual term that you manage the company in a private equity, like in an angel, like in the venture capital. Management of the company is also shared. For example, I'll tell you. I gave you the example of mutual fund. So this guy floated a mutual fund and he picked up money from public and he invested. That's all he did. He invested in NTPC and CIL. He doesn't know anyone in CIL or NTPC. His job is buy the share, sell the share, generate returns, share the returns. Whereas a PE guy, like the angel, like the venture guy, all of them have one thing in common. They give you cash and they sit on the management to turn the company up. Whereas the first two, angel and venture, startups. PE guys, both startup as well as existing companies who want to do much better. That is how the three have to be understood. So, okay, that's also. Now you come to NBFC. NBFC. Non-banking financial company. Non-banking financial company, financial company. See, we haven't done banks, but what we know, bank is a financial intermediary. I gave 100 to the bank lent it to somebody, bank gives me 2.5%, bank collects 5%, and in the 2.5 gap, 1.5 is what they call a profit, whatever. Financial intermediary between investor, depositor, or investor, whatever, the guy who supplies the money, and the one to whom they in turn supply money, intermediary. He is the one in the middle. Non-banking finance company also takes money, lends it, invests it, intermediary, returns the money, made profit there, and then returns the money with the promised interest. So NBFC is also a financial intermediary, but there's a difference. Non-bank finance companies, non-bank it is called. You know the litmus, the core, the signature of the bank is, it accepts CASA, current account, savings account. Nobody else does. How do you identify a bank? Blindfolded. CASA, current account, savings account. Whoever is accepting current account, savings account is a bank. If you are not accepting CASA, you are not a bank. Black and white. There is no ambiguity here. If I accept fixed deposits, you are a non-banking finance company. I can float shares. Everyone, whoever, a lot of people can float shares. You know, I can issue bonds. A lot of people can. The definition, the differentiator is this CASA. And this is NBFC, this is bank. So non-bank is that. It does everything that the bank does. Most of what it does, it may do, but then it can't issue CASA. But generally, NBFCs are specialized. Somebody specializes in consumer finance, somebody in infrastructure finance, somebody in housing finance, and somebody in microfinance. So NBFC is a specialized financial institution, resembles a bank, but is not a bank because the core feature of a bank, which is acceptance of CASA, an NBFC cannot do. That's a differentiator. But RBI regulates them. All NBFCs are regulated by RBI. Banks are also regulated by the RBI. And because you don't accept CASA, the regulation on the NBFC is less. And that is creating problems, I'll tell you. There is State Bank of India. Where is State Bank of India? It lends to an NBFC. State Bank of India is regulated well. It doesn't go wrong because RBI is looking at it like this. But it has lent to Ireland, FS and others. RBI doesn't regulate them so closely, so rigorously. I'll give you an example. One example is, there are so many banks in the country, and you put money in a bank. Which bank? XYZ Bank. There is a Deposit Insurance and Credit Guarantee Corporation. In a bank, up to 5 lakh of your deposits are insured. The bank goes bankrupt, your 5 lakhs, up to 5. You got more than 5? Up to 5 is insured. XYZ Bank, you've got 150 accounts. All the accounts together in a certain bank, 5 lakh rupees of yours, up to 5, insured. So some deposit insurance is there, some deposit insurance is there. NBFC is not covered by the Deposit Insurance Credit Guarantee Corporation. It's not covered. You are taking money from the NBFC, you are lending money to the NBFC. NBFC is dealing with the people, accepting FDs, floating shares, floating bonds listed on the stock market. But then, my deposit, your deposit in the NBFC not covered by the insurance at all. So, banks are supporting NBFCs which are not so closely regulated. There is a risk to the consumer there, number one. Secondly, so here is State Bank of India, I'm RBI. State Bank of India borrows from me under the repo, 6.5. Accordingly, they structure their interest rates. Under the repo, NBFC is not eligible. So they charge 10%, 15%. You know, interest rates they charge are very high, over which the RBI doesn't keep a close regulation. That again goes against their own health, number one, consumer number two, financial stability, because the money they are lending is borrowed from State Bank of India, Bank of Baroda. Anything goes wrong there, it will take down the bank also. So, you know, there are problems about the NBFC. That is why the RBI has come up with a different type of regulation. You know, scale-based regulation. You are a big NBFC, regulation is X. Not so big, not so big. So tomorrow in the preliminary, the question can be scale-based regulation. Scale-based regulation. rules have recently been introduced by the RBI in order for the following type of financial entities to be better managed. Non-banking finance companies, mutual funds, banks, development financial institutions. NBFC is tick and go, scale-based regulation. You know, we'll have another occasion to talk about it. It's there in the big notes of mine. I'll also talk about it. Scale-based. You know NBFCs, and you know all these things now. Now I'm going to talk about little more of the, little more of the capital market. Few more bonds. Sovereign gold bond, sovereign gold bond. Any graphic now? Okay, let's have capital indexed bond. I think you wait. There are 5 types of bonds I'm going to talk about, and after that we will see the tables. Capital indexed bond, inflation indexed bond, special securities, sovereign gold bond. Sovereign gold bond. Same logic. RBI is there, government, that is RBI. Sovereign gold bond. Don't buy gold, buy paper, so that we don't have to import gold and spend our precious forex reserves. Buy the paper, lock in, there is some maturity, after some time you can sell. Maturity is longer, this is the maturity, but you can sell here. And gold price is going to go up, make no mistake about it, under all circumstances. Uncertainty is equal to gold doing well. What they call hedge against inflation and all that. But there is no direct link with inflation. Hedge against uncertainty. So, buy the paper and we'll even give you 2.5% interest, and that has some tax incentive also. Why should you give interest? Because I don't want you to buy physical gold. That will be at the expense of country's forex reserves. I want to de-emphasize the ornamental value of gold. I want you to all invest in Reliance shares, NTPs, whatever that is, and government bonds, RBI, retail direct, so that the money goes into productive economy, and thus I want you to find the sovereign gold bond attractive. You will see a graphic a little later, not now. Now, that's one capital market instrument. Another is, see, today on the paper, statistically speaking, inflation is moderating. some 5 something. There was a time for month on month, you had inflation 7, 8, WPI in double digits. So, ordinary man, he wants government to protect his money. See, I'm working hard day and night. I have no knowledge of economics and investing. I voted for you. You are the government. Protect me. That is the least that I can expect from you. I'm not even asking you to promote me. I'm asking you to protect me. I've got 100 rupees. See, 100 rupees. Inflation is, let's say, 5. Next year, my 5 inflation has eaten up 5 of my 100 and that is reduced to 95. So what am I asking you? I'm asking you, protect me, my money. Yes? So what will you do? Okay, no problem. No problem. Give you 100. What is the interest? What is the inflation? 5. So your 100 will be 100. We will protect. And we will give you whatever the rate of interest, 5%. So 100 will be 100. On 100 we will give you 5%. So your money is protected against inflation. The principal is protected against inflation. That 100 and 5%, you are protected. WPI, CPI, that can be worked out. So your principal is protected. So what do? There's a bit of a math here. 100, 5. Inflation, 5%. This is inflation. And 6% is the interest. So you gave me 100. How much is inflation? 5. So that 100, I will make it 105. So that you are protected against the inflation. But the interest of 6% I promised you, I will give you only on 100. So I am protecting your principal. The interest I am giving only on 100, but the principal I am protecting against the 5% of inflation by making it 105. So 105 is 5% on 6% on 100, 60 paisa something it will become whatever it will become, and that will be added to 105, our graphic. That is the capital indexed. But then you will tell me you just indexing only the capital, you have to index me the entire amount by capital and the interest that I am getting. I want to be paid 6% on 105, not 100. Fine. That is inflation indexed bond where 100 is what you gave me, 5 is the inflation, so it is 105. On 105, I will give you 6%, not on 100. So I am protecting your principal. I am also protecting your interest by calculating the interest on the principal as it is adjusted to inflation. So 6% on 105, there 6% on 100, principal is 105, etc. Special securities I will come to a little later. In the meanwhile, today we haven't seen any graphics, so let us, one second, bills and bonds comparison, let them see, because they know the bill, they know the bond. Zero risk. Whenever you talk of the government security, don't say low risk, zero risk. According to the Basel Committee, Switzerland, investment, you have money, 100 rupees, zero risk. You have 100 rupees in government security, zero risk. Only 2 financial products are zero risk, money and the investment in the government security. Is it right or wrong? Rupee can be stolen, but that the RBI is not responsible. Government can go bankrupt? Generally they don't. Take a look. Issued by the RBI on behalf of union government and state government. RBI is the one that issues on behalf. You can't issue and pass it on to RBI for them to sell and all that. They issue. There's a contract, RBI Act, according to which on behalf of the government, RBI does all this. You're okay with this? Yeah. Next. We have seen this. Now you doing all that.
None of it. Already it's
Oh, this was from yesterday. Did we see this yesterday? Discount and Finance House of India. You have a bill, I will discount it for you. He wants to discount, I'll give him the money. Either way, you know the concept of discounting. Please have a look. I think you have to magnify this. I think so. Unless, is it okay? No. Yeah, they know this. Discount and Finance House of India. This is only to make yourselves familiar. The real thing that's going to come in the exam, some we already spotted, more we'll spot.
So, what is secondary market?
Secondary, TCS, investors. I want to issue some shares. You guys are interested. You are interested? Take this share, give me the money. Primary market. You got the share? He wants to buy the shares. Stock market, Bombay Stock Exchange. You want to sell because it already appreciated 10%. He wants to buy because he thinks it will, go higher. So, I have issued, you have invested, primary market. You want to sell, somebody wants to buy, you want to buy even more, you do all that, not from me. In the stock exchange, that's the secondary market. Stock exchange is a secondary market. Buying from the issuer directly is the primary market. Got it? Yeah. Government dated securities. What are dated securities? Give me 100 now, after 1 year you come and take with interest. That is a dated security. Yeah, that is a standard type of a government bond. Dated security. It has a date, 1 year, 5 year, 10 year, 20 years, whatever. And it carries certain interest, coupon, whatever you like to call. That is a government dated security. There are some special securities, undated. There is perpetual bonds, they are called. I don't know when I'll give you the money. I'll give you interest till then. When I'll give you the money for principal, I'll let you know. That is undated. Generally bond is dated, except perpetual bonds, they are undated. Next. Oh, you're okay or? This is fine. It's just, yeah. Here? Where?
One more minute.
One more time. You said once more.
He said, just asking for a minute. He's asking for a minute.
Oh, please, please take. I thought I was taking more time of yours. You know, please take. This is the crux of it.
So why treasury bill are not issued by state government?
Why?
Treasury bills are not issued by state government.
See, what happens is, you are the union government, RBI. Tell the RBI, sir, you float a treasury bill and pick me money. Then the RBI will phone you, sir, 91 treasury bill. Tomorrow is the 91st day. Guys are going to come for money. Then you will tell the RBI, float more treasury bills, sell them, get me the money, with that I'll retire them. That because you are the government of India, this and that, Forex is in the union list, you could do it. Imagine 28 states being allowed to do the same. You know, India will go anarchic. So states, after all, I am XYZ state. I've told the RBI, go for a T-bill for me. I get the money. Where are my returns? I'm going to use that money to build a road. Road fetches nothing. T-bill, 91 day, building a road. So state governments may not be able to generate returns, number one, in which case they'll be in a debt trap to borrow, to repay what is borrowed, that is a debt trap. And so, in order to ensure financial stability, fiscal prudence, states can't issue short-term bills. That's the logic. Just the states can't borrow from outside the country. Only center can borrow. Why? Once again, there will be pressure on the rating of the government. There will be so much of borrowing. You won't be able to return. The union government will have to, return the money. Pressure, downgrading of the rate. This will come much later. Social, I have not discussed. Just a second. This I want to discuss. These are all current stuff. What I discussed, for example, discount finance house, traditional knowledge. Will the question come from there? Maybe, but this is current. See, there is a social enterprise, and you know what it does? He wants money to build sanitation. He will charge people for using the toilet, so lab, etc. And then he'll go on, it's not for profit. It's an NPO, non-profit organization. Who will get him funds? How will the world know that he is looking for money? He's a great guy, he's doing good work. So in the BSC, Bombay, in the NSE, National Stock Exchanges, there is a platform where all these guys are listed. There is this person. He wants to lend 100 to a social enterprise. I told you, sanitation, afforestation, whatever. Skilling. He wants money. Guys are ready to lend money. They don't know about me. So here is a platform, social stock exchange, where I am, registered. The guys who want to lend money under their corporate social responsibility or otherwise, they can lend money. But what is this? This is not lending. You are giving me money, it has no interest, zero coupon. I won't even return the money to you, zero principal. It is just a place where I can collect money from you and I will use it for XYZ purposes. What the contract has, maybe the contract will have this, that, whatever, all that. Z, C, Z, P. Zero coupon. Coupon means interest. Zero coupon, zero principal. I'm not returning the money. You're not expecting the money. It's just that I'm there so that you know I'm there and I'm doing good work. You got the money to spare. You will give me and I'll use it well. That's all. Zero coupon, zero principal bond. Regulated by SEBI. Take a look. You got the concept, that's all that matters. SEBI regulates. And we skipped one somewhere here. Social stock exchange, that's what it is meant for. And this is I remember the finance minister announcing it some years back, 1 or 2 years back. It's not come. It's a pretty good thing. NSE, National Stock Exchange has it. PSC also has it. Social stock exchange, where all these guys, non-profit, all these people are there. They're registered there to mop up money. Yeah. And they have not started operating, at least till August. After that, I have not seen that they are operating. They have SEBI granted them the recognition. NSE and BSC, February. In August, SEBI made some rules. So this is the social stock exchange, a platform where NPOs, non-profit organizations, can mop up. Social stock exchange. Next. Green bonds, blue bonds. Okay, I'll talk about it. Blue bonds are, blue economy is ocean related, sustainable use of resources related to ocean. Marine resources. That is a blue economy. You want to float a bond for raising money for fisheries, marine pollution treatment, that will be a blue bond. Green bond is renewable energy and green agriculture, etc. And now you will see a graphic of a government green bond. NABARD is social bond. Social bond is housing, poverty alleviation, etc. Only NABARD raised with the social bond as far as the government is concerned. A second, just go back a little bit. I'm going to come back to this. This is something you need to know. You know why. NABFID, National Bank for infrastructure and development, financing, infrastructure and development. I will take a bit of time, not now, I'll handle this. And this is about the hit list in that number one. I'll come back. In the meanwhile, because to talk of this, I have to talk of DFIs, All India Financial Institutions, somewhere here, All India Financial Institutions. All that I need to talk of, not now. Now I'm looking for the graphic, the black graphic sent to you pretty recently.
Green bond.
Oh, no. Go. This is stock market, large cap and all that. You're running so fast. Okay. So this is the calendar. The government of India, this is again a top level question for your prelim main. Government of India floats bonds, RBI issues, and I tell them and they get me the money, this, just like the government sector. Last year, 22-23, last year budget, the finance minister said, we are hitting the market for green bonds within the India, not outside, sovereign green bond. Tell the RBI, sir, you float a green bond. And so what's the big deal about the green bond? See what happens is, there are people who believe that they should be responsible investors. ESG. That is environment, social, governance. I want a company which is committed to environment. If they float a bond, if the market rate is 7, I will lend them at 6.8. Why? I am ready for the discount because they are doing a good thing. If they are socially inclusive, if they are employing all society, gender, caste, region, all that, I'm ready to lend them at 6.8 while in the market I'll get 7. Similarly, if they are governed well, good directors and inclusion, etc. So when the government of India floats a green bond, there are people who will lend it to the government of India at an interest which is slightly less than what the market otherwise fetches them because the purpose is good, green. So, but then it didn't matter too much actually. And it didn't matter too much. They got slight concession. Last year they picked up about 16,000 crores of rupees. This is the calendar for this year. They're hitting the market in November for 5, December for 5, Jan for 5, Feb for 5,000 crores. The bonds are 5, 10, 30 years, 30 years. This 30 years they have announced in the calendar. Who knows, maybe they'll extend it to 50 years as a novel because they're looking for headlines and all. This is a sovereign green bond. Government takes it, invests in it, and government invests somewhere. Irrespective of the returns on the government investment, you are guaranteed. You will get what you will get. You will get what you will get. Whatever you promised, some 7%, 6.9. This is a sovereign green bond. You please take a look. Everything about it is green. It's all green, green. Saturated with green. I don't know if it's a green heart. Take your time. Question hasn't come. NABFID, question hasn't come. Zero coupon, zero principal, question hasn't come. Social stock exchange, none of that has been asked. There should be 1 or 2 questions on this. And after you have exhausted, I'm coming here, for which there is a graphic again. We'll show you after I've discussed. Fully accessible route. This can also be a good preliminary question. Very simple, tell the RBI to float a green bond. And you want more details? The thick book has all the details. I have gone into the Finance Ministry website and all the green bond principles, etc. You want even more, you go to the last chapter, infrastructure. In that, green bond principles globally accepted, that is there. But what matters to us is the Ministry of Finance website. From there, I have taken the crunched it. The crux, it's there in the Indian economy book. Please go through.
Sir, who regulates it?
Yeah?
Who regulates it?
RBI issues. So RBI, only the color of the heart is green, otherwise same thing. It's a government bond and you're raising money a little concessionally, that's all. Because, if I can use a strong word, greenwashing. This question came in the prelim last year. Greenwashing is, see, you guys want to invest in green projects. So I will fake green. I'll greenwash it. Give me money at 6.5, not 7, because it's going for a green project. I will fake green. That is called greenwashing. Just like it's not clean but you whitewash it. Just to make it attractive, you greenwash it. Is this greenwashing? Definitely not. I just thought, I will let you know another concept also. And you may ask me, who are the underwriters? See, the concept of underwriting is, I already dealt with it in the money market, government, RBI, or a company. What happens is, there is somebody who is selling the securities on my behalf. I don't do it directly. He's a primary dealer. I'll tell him sell. If there is no buyer, sir, you told me to sell for 100 rupees. There is a market only for 99, sir. Therefore, that 1 rupee gap, I am buying. So here is the 100, sir. So the underwriter is the one who fills the gap between the demand and the supply by buying it himself. And when he is selling the bond, when he is buying the bond, he completes the market, he makes the market, that is, he creates the market, all that. So he is the underwriter. He is the underwriter. For the RBI, he is called primary dealer. Say I'm a company, I'm going public for an issue, IPO. IPO means first time I'm not discussing all that right now, because we are going gradually. So I'm a company, as of now private limited, I haven't gone public. I want to go public. So who do I consult? Who will guide me? I don't know. I'm a pharmaceutical company, construction company. My knowledge of finance is not adequate. So I asked the investment bank, merchant bank. Merchant bank is investment bank. They deal only with corporates. So I asked them, what do? I want to go for an IPO, issue shares to the public, get the money and invest. And they are my shareholders, they are my co-owners of the company. I want them to benefit because I'm going to create wealth and the share price will go up and they'll all be prosperous. So he tells me, okay, your company is worth 100. You can go public with 25 shares. You can price it at 10 rupees each. I'm sure there is market. I'm sure about my valuation, not like Paytm. That Paytm fellow, he floated the share at 2400. Classical. And on one certain day, I saw the share price at less than 500. Imagine the middle class that bought at 2400, thinking Paytm, competitor for Google and Apple. 2400, it landed at 500. Of course, he bought back a little bit. Even the buyback today, maybe it's still quoting at about 60%, discount. When will these guys get their money? So they're, total scam. I don't want to use scam and all that, but what else? If I may avoid, I have invested Paytm 2,400. Right now, it's at 900. When it was 500, I had a heart attack. Find me a word, So, underwriter, the guy who advises me on going for IPO and, runs around to SEBI and gets me all the clearances, arranges for the IPO, price and all that, and tells me if there is not much of demand that he estimated, he will fill the gap buying it himself. He is the underwriter. And for the government securities of the RBI, the underwriter is a primary dealer. That's the definition of underwriter. See, primary dealers. I'm the primary dealer. I can't handle so much. So I've got satellite dealers, that is sub-dealers. We all distribute the responsibility for mobilizing the money and also the risk. There hardly any risk, it's a zero risk thing. But then when you're locking your money here, there are other opportunities. You're foregoing money locked, and that is a cost. We share the returns and the, the costs. He's a sub-dealer, satellite dealer he is called. I'm the primary dealer. We do the work together. What the investment bank does for the private corporates, the primary dealer does it for the RBI. Another? Fully accessible route. See, there is market, government securities market. We don't want the foreign institutional investors to come. We want them to come, but then we can't throw the market open to them. After all, there are risks. So, we throw the market open gradually to them. There are some securities in which we want the foreign investors to participate 100%. How much you want to buy? Buy. Domestic guys are also there, you are also there, you buy. Some securities we will allow you only 20%, whatever. 20%, I want to raise 100, 20 rupees are open to FIIs. Here I want to raise 100, just buy what you like, as much as you want. You and domestic guys, both of you buy. You can buy as much as you want. There is no ceiling. So fully accessible route. For that, only some securities are singled out, open for FIIs, fully accessible. Others there are ceilings. This is FAR. RBI came out with this some few years back, just 2-3 years back, maybe 4 years back. And it's a news of late. FAR, please take a look.
Last question says, who can participate in FAI? And it says non-resident and domestic investors.
Non-resident means foreigners who are not citizens of India. Yeah.
Right, but the first question says Reserve Bank of India to allow non-resident investors to invest in specified.
The word resident here means, don't go into all that citizenship and all that. The one who is not a citizen of India, number one. Foreigner, American mutual fund, they can participate, yeah, registered with SEBI and all that. Another guy, if you go into the rules, maybe the non-residents living outside but they are citizens, they can also participate, whatever. But let's use the word non-resident, that's broad enough. Non-citizen, citizen, non-resident, both of them can participate. Now what's your question?
The question is the same.
Did I answer you?
Yeah.
Okay. And this, lot of people will trip up on this. Who can participate in the subscription, in the selling, buying of certain specified government securities? Foreign, domestic, neither, both under the FAR. Lot of people will say, only foreign, non-resident. No. This 100, earlier I kept only this much for you. Now open, whatever you want to buy, you buy. 100 rupees is there. You guys go on bidding. Fine, these securities. I will give to the guys for whom I pay the least. So there is no ceiling. Without ceiling, the purchase and sale of purchase of the securities is open to foreigners. Domestic guys always could buy whatever they liked. Foreigners were restricted because of the implications, volatility. And obviously they are not Indians, so there will be some reservations. So those reservations are kept aside, it's open to you, fully accessible route. The point I am making here is non-resident and domestic both can participate. FAR, another thing here. Comparison, let's go to RBI. I was telling you about the regulatory functions of the RBI. We looked for a graphic we could not find, and so here it is. All this that the RBI does, they are all under the banner regulatory functions. It works as a revision also for you. Take a minute or two. They are all regulatory. Corporate governance means how the corporate is governed. On what does it depend? Disclosure, transparency, the quality of the management, who are the directors, all that. So RBI tells you, sets the corporate governance standards also. You can't appoint anyone as an independent director. Obviously, he has to be independent, for which there has to be integrity, reputation, expertise, all of them in one person. You are okay because we, asset quality monitoring, I'll tell you. Liquidity requirements, SLR, CRR, repo. Asset quality is C, RBI. You are the commercial banks. You give credit to a variety of borrowers, agriculture, small, medium, exporter, infrastructure, stock, etc. What is the state of the loans that you have given? You've given loan. If somebody takes the loan, is not returned the loan, RBI should know that it's a non-performing asset, bad loan being built up. So RBI wants you to be clear about the asset quality. Who took how much? Have you given the same guy a lot of money? He's been defaulting but you are giving him more money so that you can show him to be on time returning the money? Evergreening? Window dressing? The only way you can be stable and do well is by prudence, transparency. If you can't do it, let the RBI tell you what to do. Asset quality. What is the quality? Asset means all the money that you gave is your asset. And the guys whose money you are lending, they are your liability. You have to. The loans that you are giving, what is the quality? How much is a good loan? How much is a bad loan? Bad loan for how long? 1 month, 2 months, 3 months, 1 year, 2 years? I would like to know. So that some remedial measures can be taken in time. So that is asset quality. Rajan introduced all that. Loan quality, repayment, like likelihood to minimize risk and all that. If somebody is not returning the loan to you and you have to catch him in time so that something could be worked out. If you don't catch him in time, then it is bound to become loss making. Supervision, online and also on site. Capital requirements, slightly, technical. Means for today it's technical. I'll break it down for you, Basel norms, etc. when we come to banking. Within no time we'll be there. Next. Bonds. Okay. I think we talked of bonds. They are in use, but the UPSC also has given it twice in the last 3 years. I don't know. Take a decent look at it. Bond, price, yield, what happens when there, I have seen foreign papers, Indian papers. In America, the 10-year government bond is right now fetching 5%, which is by American standards astronomical. And in India, it's fetching 7.5 today, some paper. So why is the interest on the bonds higher? I have a bond for 100 rupees. It's fetching me 4.5. You know what I'll do? The inflation is high, rates are going up, Gaza, crude prices will go up, inflation will go higher, rates will go higher. It's getting me 5, it's getting me 4.5, 5. 100 rupee bond, fetching me 5. Interest rates are going to go up. Next batch of bonds will fetch me 5.5. So what will I do? The 100 rupee thing I'll sell off at 95. The guy who gets it at 95, his yield is 5% plus, because 100 should get him 5, 95 is getting him, without giving 100, he is giving only 95 but getting 5. If he gave 100, it will be 5 plus. That 95 I have, I'll buy a bond which fetches me the new batch of bonds 5.5. So when you sell less than the price face value, yields go up, he is fine. In the new culture, in the new economy of inflation and high rates, he gives 95 and he gets 5% plus. With that 95, I buy a bond which on the face of it itself 5.5. So everyone is settling down to, the new reality. He is fine, I'm fine. So that is how the face value, interest on it, the actual yield which depends upon the price of it, etc. I hope you got this. If you haven't, you must ask me. Take a minute or two, try establish the connections. Any problem, I'm here. Think with the help of this. What happens when interest rates rise? What happens when interest rates drop? You're okay with this? You've understood? But this requires some sitting down and understanding. Among all the things we've been building up, this requires 2-3 minutes of connecting. Ask me to explain whatever you like. Put your feet into the economy. Not the head, feet you put into the economy. Then you'll, when you tell me to move from this to the next one, we will.
Sir, how bond price increase will result in yield increase?
How bond prices?
Increase in is resulted in yield increase.
resulted in GDP. Yield, okay. 100 rupee bond. 100, face value is 100. That's the price of the bond, 100. 5% it's fetching me. Yield is 5, price is 100. Now, lot of demand for the bond. Lot of demand. You all want to buy the bond. Just, you know. So you say, I have 100, I want to buy your bond. All of you want to buy the bond. So I will say, I can give you 4%, 3.5%. You all want to buy the bond. Lot of money, less bond. So, I can borrow cheaper. If you don't want to buy, I have to tell you, I'll give you 5, 6, 7. Oh, no. But if you all want to buy the bond because the bond is the safest and stuff, then I call the shots. I'll give you 4, 375, 3.5. Demand for bond, interest is low, yield is low. No demand, yield is high. That is the general principle, demand and supply. Now, I'll give you one example. You know this JP Morgan, they have a global index in which they show Mexico, Argentina, etc., how the government bonds are doing. We want to have Indian government bonds, how they are doing in the JP Morgan Emerging Economies Government Bond Index. So you guys have investable funds and you want to see which government is doing well in the emerging economies, like all essentially global south. Better ones as Indonesia and Turkey, Mexico, etc. Maybe somewhere here, maybe Malaysia, all those. How the government bonds are working. Is there demand? Are they stable? Yields are going high because people are selling. We want to be there. Once, next April, they're going to put us in the global emerging markets, government bonds index. And the whole world, there's too much of money there. They don't know where to keep. They're looking for government bonds. India is one, but they have no idea what's going on in India. JP Morgan says this is how India is doing. To begin with, put JP Morgan, the index India, you've arrived. On top of that, you do well and it will attract investment. So you guys are, investors. Government bonds, Indian government bonds are there. I have a bond, 100 rupees. Interest rate, 7.5. There's a lot of demand for the bond. So the 100 rupee bond, lot of demand for the bond necessarily means less of interest. No demand means more interest. So this 100 rupee bond, you want to buy it for 101, 102. So 100 rupees, 7.5. Same bond, if because of the higher demand, if you are buying it for 101 or 102, what is the yield? On 100 you are getting 7.5. If you give 100, 7.5, but you are having to give 102, so the interest rate is 7.4. So the higher the price, the lesser the yield. The lower the price, the more the yield. Okay, tomorrow, God forbid, India is not doing well and I am selling my bond. No takers, this 100 rupee wala, I am selling at 98. On the face of it, the price is 100, yield is 7.5. But there is no demand. I have sold it at 98. So, just by giving 98, you are getting 7.5. So, you are getting more than 7.5 because it's a 100 rupee bond, fetching 700. For you to get 7.5, you must give 100. But at 98 itself, you are getting 7.5, which means you are getting 7.6. In panic, if I sell less than 100 the face value, the yield is more. Price is less, yield is more. And if the demand is there and face value is less than the real value in the market, then demand is more, yield is less. That's a global, universal, historical principle. Where the demand is high, yield is less. Where the demand is less, yield is more. You got the point now?